So welcome to Investment 101 in Transformative Finance. This is part of the EPIP webinar series on Wednesdays. And if you're new to EPIP and this is your first time joining us on a webinar, welcome. We wanted to just give a quick overview of who we are and what we do. EPIP stands for Emerging Practitioners in Philanthropy, and we're a national network of foundation professionals, social entrepreneurs, and other change makers who strive for excellence in the practice of philanthropy. We are a platform to connect with each other, to learn and practice leadership skills, to inspire emerging ideas in the social sector. We are excited to be in the process of rolling out our new strategic plan, which has been very member-driven and has raised up the voices of folks from across the country who are part of the EPIP community. We have 15 local chapters that you're very welcome to join and get involved with. And we are, in addition to the things you see on your screen, increasingly also committing time and focus on how to push forward equity and social justice in the sector. If you have any questions, or if you'd like to learn more about what we do or how to get involved as a member, please feel free to email me. My email is on the screen right now. It's biz@epip.org. And I wanted to just put a quick placeholder for some upcoming events. We have a webinar being planned for, it looks like June, which will be an opportunity to talk about countering systems of hate. Please stay tuned for details. You can check out our events page at epip.org/events for any upcoming webinars as well as chapter events. And then in lieu of an annual conference for EPIP this year, we are joining our partners in the Change Philanthropy Coalition for the Unity Summit, which is going to be the week of September 18 to 22 in New Orleans. You can check out the website, the EPIP website, or changeunitysummit.org to learn more about that and how to get involved. Registration will be launching soon. For today's call, just some housekeeping notes. First, you'll see in your control panel that there is a place to write questions, and you should please use that question box to let us know if you're having any technical difficulties with the call. If you have any comments or questions that come up throughout the course of the call, we're going to be doing question and answers at the end, but I would love to help make sure that your questions get into the queue for that question and answer period, and that if anything urgent comes up throughout the call, we're able to help you sort it out while things go along. We're going to be taking a couple polls today. Those are anonymous. Your questions can also be anonymous if you let us know you'd like to not be named when we read your question. If you're following us on social media for today's webinar, please use the hashtag EPIPwebinar to help keep the conversation in stream there. We are recording today's webinar. It will be available along with the slides and the resources that are going to be provided at the end of the call on our archive page before the end of the week. And at the very end of the webinar, there'll be a quick post-webinar survey that asks you about your experience on today's call, as well as asks you about things you'd like to see more of in the future. So if you have a moment, please fill that out. It helps us keep providing content in a way that is meaningful for you, and hopefully that helps you in your work. So without further ado, I'm excited to briefly introduce today's speakers. Alex is actually going to do the bulk of the introduction, as in he was definitely seminal in helping make this webinar possible. We had a conversation almost 6 months, I guess, or more than 6 months ago now, about this topic, and his breadth of knowledge and experience in the field has been super helpful in making this webinar possible. So Alex, welcome to the call. Andrea, also thank you for coming today. I know Alex will introduce you more in depth, but we are really grateful that you've put so much work and time into connecting with EPIP today. So we hope this will be the beginning of many conversations. And now I am going to turn the mic over to you, Alex.
Thanks, Biz, and happy to be speaking with everyone today. So I wanted to start by talking a little bit about how I got to where I am and why Biz and I had that conversation over 6 months ago about why I think this is such an important topic for the field of philanthropy and also for the EPIP community. So why mission-aligned investing? I've spent my entire career working at philanthropic intermediaries, public charities. I've never worked at a private foundation. And early on in my first position, I was lucky enough to get to work on both grant making and community development lending. And I noticed even then that those strategies, although they thought perhaps that there were similar goals, were actually really not super well coordinated in how those different types of ways of deploying money were working together. So I've got a little image here that I thought would be helpful. I got it off of, it's from Mission Investors Exchange. And it shows, multiple different types of investments and grants that can go to support the same positive mission impact. But the issue that I have come to learn over my career, and why I think it's so important for EPIP and the future of philanthropy to talk about this topic, is that the issue really for me and the question goes deeper than just how we deploy these different kinds of tools in our toolkit to the question of the foundation and the private foundation as such. I once read an article about Harvard that described Harvard as a real estate and hedge fund concern that happens to have a college attached. And I've come to feel, honestly, a little bit similarly about some foundations. They are very large investment funds that happen to have giving programs attached, and how many of the private foundations operate and manage their endowments. So at RSF Social Finance, we really think differently about what assets and asset management can do. We see giving and grant making as an essential part of the economy, and we see investments and lending as tools for social and economic transformation. And as I said, personally, I believe that rethinking the basic structure and purpose of the foundation in this way is really critical for us as a field to move away from thinking about philanthropy as charity and towards thinking about philanthropy as reparations and redistribution. Can you move to the next slide, please? So then, if that's why I think it's important generally, why is it important for EPIP? In my experience working with EPIP and the EPIP community, and also with mission-related investing, I have found that program staff at foundations often feel very left out of the conversations about how the assets of the foundations we're working for are managed when those assets are being deployed in ways other than grants. But I think that mission-related investing is increasingly essential, as I said, to the future of philanthropy, and it's also becoming increasingly popular and prevalent as a hot topic in philanthropy. As you can see in this photo, this is a recent panel with Darren Walker from Ford, who just announced that they'll be investing a lot in a huge portion of their endowment, well, a large for them portion of their endowment in mission-related investing over the coming years. And that's Priscilla Chan and the head of the Goldman Sachs Foundation there. So they called it the next wave of philanthropy. I think part of this divide between the program staff and the investments has been reflective of a larger cultural divide where, frankly, many of us who don't work in finance are scared of finance. We're scared of the specialized jargon. We're scared of the siloed work that happens in those investment committees and with those investment managers. And these are silos we really need to break down if we're going to be effective at mission-related investing in the future. Personally, I think that activating the whole portfolio of a foundation is really going to be critical for this future. So I'm going to speak a little bit about how RSF does this work and then turn it over to Andrea. So for RSF, our integrated capital approach is really critical to this. For us, that's the coordinated use of grants, loans, and investments to support mission-driven enterprises. The picture that you see there is from an enterprise we supported in San Francisco called Veritable Vegetable. That's a local organic food hub. We were able to provide them with both a grant and different types of loans to meet their needs, as well as introduce them to other people in our networks who were able to provide them with equity investments to support their social enterprise so it could grow and continue to maintain its mission of supporting the local food economy here in San Francisco. And we were only able to do that because we could coordinate grants, loans, and investments under one roof at RSF. But luckily, private foundations also have access to grants, loans, and investments, so they too can deploy this integrated capital approach. And the how and why of what those investments look like is something Andrea is going to get into in a minute. Next slide, Biz. And then the last thing I wanted to mention is an emerging initiative that I've been working on called Shake the Foundations. So this is an economic justice project that's made up of both foundations and economic and climate justice movement organizations who are advocating for foundations to participate in a financial commons model. I'm not going to get too deep into this right now, but if you're interested in learning about it, please feel free to email me directly. We are still in the sort of learning and structuring phases of this initiative, but the idea is to turn more and more control over the pooled assets of foundations over to communities to make both investment and grant making decisions themselves about how those funds are most needed and most used, could be best used, and to provide the tools and difficult conversations that foundations need to move more of that money into community control. So those are two ways that I am engaging with some deep mission-related investing and really rethinking what's possible with philanthropy. And I'm looking forward to questions and discussion about those either here or offline later. But for now, I want to turn it over to Andrea to take a step back and talk a little bit about how and why foundations manage their investments and the way that they do, and what options we have at foundations to move those investments to align more deeply with our missions. And I'm really excited to introduce him. I've been able to participate some and watch from afar the work of Transform Finance for a number of years. And I think that you're a small and mighty organization playing a critical role in the field. So thank you, Andrea.
Lovely. Thank you so much, Alex, for the introduction. Thank you, Biz, for inviting us. And thanks to EPIP in general and for all the participants today. I will now start sharing my screen. Let me know if that works. Every one of the systems seems to work a little bit differently. Biz, let me know once this looks good.
It was up,
Yeah.
but it came down. So
Okay.
I don't know. Bear with us, folks.
Okay, it looks to me like I'm sharing it, but.
Okay, yep, I see it.
Okay, great. So again, thank you everyone. My name is Andrea Armeni. I am the Executive Director and co-founder of Transform Finance. I will be speaking a little bit today to unpack some of the concepts that Alex just shared with us. And please, if it seems like a lot, it is a lot. But this is just meant to be really a brief introduction to this topic. And hopefully some of the other resources that we're sharing with you will be helpful. And we're very committed to helping anybody who is interested in digging into the space to do so. Echoing again.
1 second, because your slides aren't visible. So sorry, folks. We're just going to do one quick technical intervention. I'm going to move this back over to you, and hopefully it'll work this time.
Okay, so see here, Microsoft showed this window. How about now?
Yep, perfect.
All right, great. Apologies for that. So the one thing that I was going to echo from Alex's comments in terms of the fear that normally surrounds the conversation around finance in the context of social change or philanthropic work. I am fortunate to come from a mixed background, having been both an activist and still considering myself one, and having worked in finance, both in corporate law, corporate finance sector for a long time, and thinking that there is really a good opportunity here to combine the two and trying to see what we can do within this context of foundations work to advance a more progressive agenda that would really lead to real transformative social change. So about Transform Finance, just a quick word. We're aiming to build a bridge between these two worlds that normally don't interact with each other, the world of capital and the world of social justice. And doing so in a community-centered way by bringing all these actors together, by supporting, organizing, and informing them. which is that bringing them together is going to be an important part of this, right? Breaking down some of those walls and some of those silos that Alex was referencing before. And in order to really start seeing some of this capital moving, because we consider it to be just one of the tools that is available for everyone, we convene an investor network that is a community of practice for asset owners such as family offices, foundations, high net worth individuals. They're committed to this idea of using deep community engagement, non-extractiveness, and the fair location of risks and returns in their investment practice. And understandably, foundations of all sorts are kind of a natural fit within that. So let's start with this idea of the foundation, right? If you ask the person on the street what a foundation is, they would probably go straight to this idea of disbursing philanthropic capital, right? It's an organization that does grants. But is it that really, or is it something else? When we see that, as Alex was mentioning, generally only 5% of a foundation's assets are disbursed in a given year, which leads you to think, well, okay, if you were to do this in another kind of work, right? If you were, say, at Goldman Sachs and you were only using 5% of your assets in order to get to your goal, you would probably get fired, right? So what is happening to that other 95% is what is really interesting to us in this conversation. So traditionally, the answer that you will get is that, well, you need to maximize the returns to the foundation's endowment, right? A foundation has a certain pool of capital. It makes its grants out of the growth of that pool of capital. And unless you grow that pool more than, say, 5% per year, you won't have enough money to disburse the grants and to continue growing that endowment in perpetuity, which in itself is an issue that I believe Shake the Foundation is working on, right? Why would an endowment need to be held in perpetuity? Why would it need to grow, especially given the type of issues that we have that are very pressing today, right? What happens 200 years from now? It's great if we still have philanthropic capital for that, but ideally we would not need that. And most importantly, as you try to perpetuate this endowment, as you try to grow the assets of the foundation through your investment practice, there are a couple of risks that clearly come up. One is the risk that you're acting at cross purposes, so that your investments are doing something that is directly counter to what you're doing on the grant side. And the other is that you're missing a tremendous opportunity to do more in furtherance of whatever the mission or the original concept behind the foundation was. So let's look at those two issues very quickly. The first is this idea of having the investment side of the house acting at cross purposes from the philanthropic side, the grant side. There was about 10 years ago this expose of the work of the Gates Foundation, bless them for all the great work that they do, because they had a health program in the Niger Delta that seemed very meaningful, right? Over $200 million they were investing there, they were granting there, but they had also an investment of over $400 million in a consortium that was tied directly to the type of pollution that was causing them to spend $200 million on some of those interventions. So they're saying, wait a second, are we really, through our investments, ultimately actually creating demand for the type of philanthropic interventions that we're doing? That was one of the early things. There have been a lot of other considerations of the sort with many foundations. I don't mean to pick on a single one of them. I just wanted to address it as one of the stark cases. The other piece that was mentioning about this 95% is, aren't we missing the opportunity to do something that would actually help advance the grant side, right? Why would it be only on the grant side that we try to achieve this social mission? This is some data from one of the resources that I have shared with Biz that she will be giving to you. That shows that for most foundation directors or CEOs, achieving a financial return is the most important aspect of the endowment. Achieving a philanthropic goal is only important for, or it's only very important for 1/3 of those foundations. So there's a lot of foundations out there that are just not aligning their capital and using it in this way. So let's see why that's the case, right? Because this is not something that is out of ill will or unwillingness to further the mission of the foundation. The general answer that you get from the investment side of the house is that, look, our mandate is to grow this endowment, and adding any consideration other than the investment consideration may reduce the returns, and that was hired just to maximize the returns. There is a second one that is less prevalent these days in some ways, that is that there might be a violation of the laws and the rules around the fiduciary duty of an endowment if you take other considerations into account. So what I called here the anti-corollary, I don't even know if that's a word, is that the two above are not necessarily the case. So the more investments exist that actually take other considerations, such as climate change, for example, into account, there is some pretty good evidence that you're not necessarily getting smaller returns. And also, it's not necessarily the case that you're violating any kind of fiduciary duty by doing so. And the other is keeping the focus on what the ultimate goal is. Again, as a foundation, you have a nonprofit charter that you're a tax-exempt charter that you're granted, and that's because you have this ultimate goal, right? And the ultimate goal is not to be an investment shop. The ultimate goal is to further that social change. So even in terms of the fiduciary duty that a foundation has, I completely agree that that you should put first and foremost the social mission that it's given. So why also is it important to take this other 95%? Is because we're facing some really, really big challenges in the US as well as in the world, and you can't fight for social change with one hand behind your back. You really need to use everything that you have available, which might be organizing, which might be political action, protest, power, whatever it is. And it might also involve, frankly, this engagement with the capital markets and with the world of investments, no matter how icky we might historically find it. So let's turn now to the meat of this. How have foundations started to align their capital with the mission? There are two main views of this. The first is to say, well, let's minimize the misalignment, right? Let's try to avoid the bad stuff. And let's use some of our assets in furtherance of the mission that we have. The second and emerging view is that no, actually all the assets can be deployed in a certain way so that we can serve the mission with 100% of what we have. We'll dig a little bit into each one of those. So starting with avoiding the bad stuff, avoiding the misalignment, the main one that you see is this idea that you've probably heard of screening or divesting from investments that are antithetical to the foundation's goals, aspirations, values, whatever it might be. The other two, the mission-related investments and the program-related investments, are on the idea of on the side of actually fostering the alignment, not just avoiding the bad. So screening and divesting. You might be familiar with the idea of divesting from the divest invest movement around climate change and around divesting from fossil fuels. Screening is really, instead of just divesting, which means getting rid of some of the stocks that you have and not reacquiring it, screening means having a policy of not taking investment positions in certain things. So how would you justify this this dual efforts in screening and divesting? One is to say, look, I just don't feel good about making my money from this. Let's say that I'm a foundation working on the well-being of boys and men of color. Well, I should really not be making my money from private prisons. I don't care what divestment from private prisons does to them. I just don't think that our money should come from there. The other piece is that you try to penalize bad actors. So in the case of coal investments, for example, by having divested from a lot of coal companies, their cost of capital has gone up. So it's now more expensive for a coal company to raise, for example, debt financing because of the meaningful divestments that they've had, which under some views, actually reduce the value of their shares. And the third piece that is important for divesting and screening is a signaling function. It's saying this is not the type of entities that we want to see in the world. We think that these are not contributing to the well-being of the world, which can have some positive effects in terms of how easy it is for companies like, say, private prisons or coal companies to attract talent, to retain it, etc. So let's move to the good stuff. So once you've said, okay, we've done all this, we're not invested in anything that is particularly bad, what can we do on the good side to invest in the things that actually are good? The first is this idea of doing mission-related investments, or MRIs. These are market rate investments, which means you're actually trying to get the same returns as you would otherwise. They're made out of the corpus of the foundation, out of its endowments, but they happen to be aligned with the mission of the foundation, because besides generating the returns, they also generate some positive social or environmental impact that is part of what the foundation is trying to do. Now, there's been a lot of buzz around this. There are a lot of foundations that have started doing mission-related investments. It's not really clear how big it is, in part because MRIs are not something that is defined by the IRS or by any other body. It's really a matter of the foundation itself saying, okay, this is something that we're investing in because it's aligned with what we meant to do. You can think of a foundation having invested early stage in Tesla, saying, oh, this sounds like a great investment. This will make a lot of money, and it's part of our interest in accelerating a transition to renewable energy or move away from fossil fuels. Alex mentioned briefly this recent announcement from the Ford Foundation that they were going to use $1 billion out of its $12 billion endowment in mission-related investments. So again, those will be market rate investments where they expect to have the same financial returns, but they happen to be aligned with the priorities of the Ford Foundation, which is great, and it has gotten a lot of buzz. But if you think about the fact that the Ford Foundation has $12 billion in its endowment, you say, okay, billion sounds great, but that also means that you have $11 billion that are sitting there, they're not being aligned. And once you've made the commitment to this, looking into why it's the case that only 1 billion out of 12 is being aligned really gets into this dynamics around how the investment side of the house is set up, the type of abilities that they have to move into MRIs, the type of expertise that they bring to their to the work. Oftentimes, investment officers are just not familiar with a lot of the things that we are discussing here. So there is a certain transitional aspect to doing this. The program-related investments, or PRIs, are the other main instrument that is being used here. So this is something that is defined by the IRS for a series of reasons. And the definition entails that for something to be a PRI, its primary purpose needs to be something that advances the foundation's goals. It can also make money, right? It can also have market rates of return, some sort of rates of return, but that can't be its primary purpose. The primary purpose needs to be whatever the foundation has set out to do on its programmatic side. And these also importantly can be counted towards the annual 5% that foundations need to disburse. There are very good reasons why that should not be the case, because again, grant capital is already pretty small, so we should not be cutting into it. And also there's the issue that a lot of very worthwhile projects that ought to be funded are not really amenable to an investment. They're not investment ready, so to speak, or investable in the first place. At this point, Biz, if you'd like to run that MRI versus PRI poll and see whether among the participants anybody has done or has witnessed PRIs, MRIs within their foundation, that'd be great.
Great. So You'll see on your screen a poll that asks if you or your employer are working with either PRIs or MRIs. If you can click on any of the answers that correspond to your experience, we'd love to get a sense of people's engagement. The character count did not let me write foundation as the last word in the last option, so that's what that stands for. And I'll leave this open for another 15 seconds if other folks would like to vote. Great, so last chance to submit your answers. And it looks like we're spread across. So 13% work at a foundation that is actively involved in PRI, MRI work. 20% split across either being interested or chosen not to do it on the foundation side, or working at a philanthropic advisory firm that works on setting these up. It looks like the biggest group is a group whose work is not actively involved in it, or rather whose employers are not actively involved.
Great, thank you. So it seems like we have good representation on all sides here, really. Are you still seeing the slides now, or do I need to do anything anymore? Great. So let's see what this what some of these PRIs can look like, just to give you a few examples that might be helpful to land this. Let's say that you are interested in both environmental issues and some of the poverty alleviation issues with farmers. A foundation could do per the IRS a loan to farmers at below market rates in order to improve the water management techniques that they use. Again, below market rate means that given the amount of risk of that loan, they're taking a lower return than what a traditional lender such as a bank would do. Or it could be on the equity side. That's what we normally refer to as stocks, right? Stock ownership. So you could be an investor on the equity side in a pharmaceutical company that wants to develop drugs that would not be developed unless there was this aligned investment, because they target poor populations, so they would not be particularly profitable. As you know, there is a trend in pharmaceuticals to just invest in the most profitable drugs. So you say, I'm going to invest in this subsidiary on the condition that you are going to develop the type of drugs that are normally overlooked because they target poorer populations. That would be a PRI as well. Or it could take the form of a loan guarantee. A loan guarantee is essentially money that you can put up in order to encourage somebody else to make a loan. So you could be there could be a non-profit childcare center that needs to expand, but it's not able to get a loan from a bank in order to expand its facilities. So you say, part of my mission is to provide good non-profit affordable childcare in certain communities. I will put up this loan guarantee as an incentive for the bank to be able to make that loan. So these are just a couple of examples to get you thinking about, what other ones could be like within the context of your own work. Now, how does this work? How does a foundation start to do PRIs? Generally, it's done through the actual establishment of a PRI program, right? This is something that goes up to the board level, where you say, yeah, let's try to carve out a little bit of our money and supplement our grant activity with these investments. So there is first the establishment of what that alignment would be between the grants and the investment piece. What the impact thesis is, right? How are these investments really going to work well together with the grant side? Whoever is setting this up would need to understand the constraints and the preferences that there are. So what is the timeline, for example, of these investments? Are we willing to do equity investments, or is there really too much outside of our wheelhouse? So maybe we'll start with some loans, maybe just loans to our grantees. What are the problems around that? You would figure out what these investable opportunities are like. Again, it could be on the easier side, perhaps, like loans for real estate type of acquisitions. And then once you have all these pieces in place, you would develop an investment policy statement. That is the document that normally governs how investments get made, right? When investment officers decide where to put their money, they don't just do it on a whim. They go back to a founding document that is called this IPS that tells them what the various constraints are. So you would have to have a different IPS. Normally it's a carve out from the general one that applies to these PRI investments. Then you establish terms for how you're going to diligence and how you're going to select these projects, right? Which ones are we going to take? The ones that have a certain amount of risk to them, the ones that are in the same geographic areas where our grantees are currently operating, etc. And then you find a pipeline of investable deals. And to give an example, we worked recently with a $1 billion foundation that did a 10 million carve out. So they are like, they put together a pool of $10 million out of their $1 billion endowment to address alternatives to predatory lending. So that could be, say, lending to credit unions or giving startup capital to some alternative lower cost lenders away from payday lenders, and seeing how that maps onto the work that they're doing on the program side in alleviating poverty in certain communities. So now that we have this very quick overview of this, and I'm mindful that it's a lot of very quick, very general stuff, what does it look like to align 100% of the capital with the mission, right? If you're going to have some of these conversations with the program officers, with the investment officers, might as well just go for broke and say, hey, why are we not aligning 100% of it over time? The Heron Foundation, famously based in New York City, is the first one that has gotten to 100% alignment. Several ones have been moving in the same direction. Jesse Smith Noyes, Packard Foundation, Compton out in California. So this is something that can be done, and we're fortunate that a lot of these foundations are very public about the process that they've done and put out resources for other foundations that are willing to move in that way. And I have there this little quote from a piece in SSIR that really emphasizes that even for somebody like Heron, this is a path that they're on, right? Even once you've gotten to 100% alignment, there's always something more that you can do. And in this case, they're looking more at the issue of community investing in the United States. So fantastic work. We hope that a lot more foundations will be getting there. Now, in a world of capital where you have literally 45 or so trillion dollars that are swirling around the capital markets, why is it that this foundation bit of capital that is meaningfully smaller, right? It's not $45 trillion, no matter how much capital is in US foundation endowments. Why is it that they play a particular role? I think that one thing that we often emphasize is that foundations have a big stage on which they can speak. They have a lot of influence. They have a lot of access politically, otherwise. They go to the galas, they go to the World Economic Forum, so they can do that. They can also drive best practices because they are in this position where they can advocate for what others should do as well. So it's not just a matter of the impact done by moving that little piece of money, it's also what it means to bring out into the world these best practices. The third aspect for why it's so important for foundations to do it is that foundations are in a particularly good position to take risks. Again, from my somewhat unorthodox perspective, I would say foundations have a bit of a duty really to take risks that other investors can't take. But say that you compare a foundation to a pension fund that actually has legally to pay out its liabilities, a foundation is in a position to take a bit more risk, right? If you don't make money on an investment, it's not like your pensioners are not going to get their pension at the end of the month. It's going to be something that has an impact only on the overall endowment. And the last piece where I think you all can play a very meaningful role coming from the program side is that there's so much wealth of information on what works in communities, on what the actual needs are, on how to engage with all the relevant stakeholders that a foundation has access to, if it breaks down a little bit this wall between investments and programs, that a lot of other investors don't have access to, right? You have a lot of investors that might want to do the right thing, but they simply don't have the wealth of knowledge, expertise, and information that the program side of the house can bring into these conversations. So if you're still with me so far and you think that there is a role for foundations to play in this space, what is there that others within the foundation space that are not program officers, that are not investment officers, they could be program officers, they could be on the administration side, could be philanthropic advisors, what is there that you can do? Well, from our Transform Finance perspective, we always think that the most important thing is to help lift up the voices of the communities and bring into the conversation those that have been historically excluded. You can bring in your expertise on the effects that these investments have. Again, you might have somebody that says, oh yeah, you know, investments in distributed solar energy are really positive, but we hear from the people that we work with on the ground that in many low-income communities and communities of color, this distributed solar panels type of renewable energy generation is not working because they end up creating indebtedness, let's say, you know, something along those lines. The other thing that I often encourage people to do is to not be intimidated by the lingo of the investment officers. A lot of it, I think, is intentionally done, not by the investment officers, but by the world of finance to exclude others. So there is a strong power dynamic there. But it would also be good for people on all the sides to learn a little bit about finance to become more able to engage in this sort of conversations. The other thing that can make you a lot more effective once you know a little bit about finance or once you have opened these conversations is figuring out who is the right person to talk to, right? And that's not always obvious because a lot of the foundation investments are outsourced to managers that don't sit inside the foundation. And once that has happened, you kind of give away a little bit the power that you have. The last piece is a lot of foundations still see this type of investment alignment as being scary for them. They don't know how to do it. They think it might, you know, make them look like fools in front of other foundations that are maximizing their returns, whatever that might be. So going for the small wins, but having a strategy around how you're going to do that, that can be a good start. So starting maybe with something like moving the cash, right? Every foundation has money management. Many of them might be with Wells Fargo or with Citibank or with the bank that you disagree with. That's a relatively easy piece. Moving the cash to another bank, such as a credit union or a local bank, or out in California, New Resource Bank or Beneficial State Bank, that might be better aligned with the spirit and the aspirations of the foundation. Other steps I would recommend that you can bring up with the rest of your foundation staff is just to have some conversations, just to start breaking down these walls by saying, let's bring us all together, program and investment staff, and see how we can start having a little bit of dialogue. The other piece, a little bit more technical, is to vote the proxies. That is on the public shareholding side. As you might have heard, if you own stock, you generally have the opportunity to to vote on what the management of those companies should do, what the board should look like. And in a lot of cases, asset owners such as foundations give up their proxies and they have somebody else that is managing them. It's good to reclaim that power. And it's good to ask, yeah, who's really benefiting from all these investments that we make? Is it going to be ultimately our mission, or is it all the intermediaries that are there? That goes also to increasing this transparency, asking your foundation to be more transparent. And the last piece would be to get trained up, get the program side trained up on finance, get the investment side trained up on social change theories and how finance affects those. Very quick example here, because I'm really curious to turn to the questions that you might have. Say that your foundation funds the arts, you might see that you can't do a grant for a theater, a small community theater that wants to be renovated, but you could do a loan, right? So you could ask your investment side of the house to see if they could do a loan instead of a foundation, see if it fits within their investment policy statement, or if not, do that carve out. And again, start a conversation with something small like that that is not overly daunting. One last piece that I will leave you with is on a project that we're working on now that I imagine might be of interest to many of you, and that's to see how you can evaluate the racial justice impacts of the foundation's investments. So, again, if you're the Ford Foundation, you've made a big commitment to social justice, to racial equity on the 5% side and on how your foundation is run. Well, what about the investments, right? What is $12 billion doing? Is it furthering racial justice, or is it impeding racial justice by, say, decapitalizing communities through tax avoidance, or by creating crappy jobs in low to moderate income zip codes where that perpetuate cycles of poverty? So I think this is the type of conversation that would be really good to have within a foundation, joining the investment side of the house with the program side. And if the particular focus of your foundation is not racial justice, it might be environmental justice, to the extent that the two are not really one and the same thing. You can have that same conversation with them on that. And remember that you have a lot of value that you can bring to this. You have information, you have a lot of allies on the ground that are your grantees that can provide you with really valuable data also that you can bring back to the foundation. And I think that is probably covering it for now. Hopefully we'll have a little bit of time for questions around all this. And thank you for having gone through this with me.
Thank you so much. Yeah, there's definitely questions coming in, and I want to encourage folks to continue to type them into the question box so we can loop you into the conversation here in these last 10 minutes of the call. The slide that just popped up is a good reminder. I am, as we move through questions, going to share the resources that Andrea has provided and his team at Transform Finance, and we'll also put those in the email to all of you at the end of the call. But to get into it, one quick question just about the last slide that you showed us about the racial equity real project. Can you say a little bit more? I was actually misunderstanding. Is that something that there is a framework to think about, or it's a question that you're suggesting folks engage, Andrea?
Great, thank you. Yeah, I look forward to all the questions. So that is a real project in the sense that it's a mandate that we got actually working on this with the Rockefeller Foundation. As far as we know, there is no framework for how to evaluate racial justice in investments in general. And this will be applicable once it's done to foundations, to family offices, to university endowments. The idea is to answer two questions. The first is, how does race show up in each asset class? What are the real determinants for racialized outcomes, right? Are municipal bonds really something that is helping or hurting community of colors in some areas? Is there really a problem around venture capital not flowing to entrepreneurs of color and women entrepreneurs? So we'll be looking at that to see where race shows up, and then coming up with some kind of easy first steps for somebody that is interested in advancing racial justice to start aligning their portfolio in that way. That's very much a live project now. I would encourage anybody to get in touch if that might be of interest to you.
Great, thank you. I have two questions right now on the board for each of you. So quickly, again, to you, Andrea, the suggestion about getting a chance to learn more about finance, both, you suggested that folks on the program side and in general take up the charge to learn more about finance. Is that something that the resource guide speaks to? Are there programs or books or tools or places that you recommend folks point to as they're starting that work themselves?
There's some early mentions there, and one of them is Mission Investor Exchange that does a fair bit of work in this area. There is a project that a consortium of foundations did, I think it finished now, called the Project Phoenix, that brought together a lot of the program officers that were interested in this MRI, PRI space. One of the other resources that we mentioned at the cost of seeming self-serving is within Transform Finance, we run an Institute for Social Justice Leaders, where we have trained both people that are directly activists on how they can learn to engage with finance as a tool in the social change toolkit. We've done it for foundation staff as well, where again, they start thinking about how their knowledge on the program side can be activated on the finance side, which for better or worse requires a little bit of understanding the fundamentals of finance.
Great. Alex, in your comments, you talked about your philosophy about reparations and philanthropy's opportunity to provide reparations through this new reframing of the work. There's a question about how impact investing flows into that versus traditional grant making, and what you mean when you say reparations in that circumstance.
Yeah, thanks, Biz. That's a really great question, and we could probably do an entire other webinar just on that question. I guess in brief, I would say what's really inspiring for me, or how I might think about that, is how philanthropy can help. Well, I guess there's two aspects I've drawn. So one is the question about who has power and decision making, and this is something that's come up a lot. Of course, in my time at EPIP. And there's a fair amount of talk, although not as much implementation as I might like, in the world of philanthropy around participatory grant making, right? How do we get communities involved with decision making around grants? How do we get communities involved with determining their own metrics for success? And there's a lot of talk about that on the program side. And I see bringing that sort of, again, to echo what Andrea was saying, programmatic intention to the investing side could also help to reframe the power dynamics there as well. Why should asset holders, foundations, be deciding where to invest their funds? Shouldn't communities be involved in deciding where the assets are most needed? So I think that's an important piece for me, where reparations and redistribution fits into this framework around impact investing. The other, I would say, is around the kinds of investments that we're making, and moving from what I would call an extractive economy that's extracting both financial and environmental resources from communities towards a regenerative economy. And again, that looks towards returning certain kinds of control and cooperation and interdependence to communities that have been most extracted from. And so I think impact investing, although not in all its forms, but impact investing as an impulse in foundations is an opportunity to continue opening the questions and moving towards those ways of thinking about investments out of a foundation's corpus.
Great, thank you. Folks will see that I'm starting to upload some of the resources I've mentioned into the handouts portion of your control panel. Again, those will also come in email, but if you'd like to take a peek at those now, and if you have questions that they spark, please feel free to type those into the question box. Another question for you, Andrea. When you were speaking about PRIs, you mentioned some opportunities may not be investment ready or amenable to investment. For folks who are a little bit newer to the investment side of this conversation, can you speak a little bit to what makes something investment ready or amenable to investment?
Yeah, absolutely. And at the risk of being very basic in the first sentence, I would start by saying that for something to be investable, it means that you need to return that money whether it's a loan or it's an equity investment, at some point money has to go back out, which means that you need to be generating revenue, right? Because you couldn't be getting a grant to repay that investment. So that's really the first step. You need to identify the type of project that actually has some revenue attached to it. In the case of the theater, possibly the theater ticket payments would be something that can generate that revenue, that can repay the loan. When you think of investment readiness generally, it really means that everything is in order, that you have a management team in place, that you have solid financials, that you have a track record that shows that you actually have the ability to use this capital that you're being given to give out. Again, massive role for foundations there, not to just say, oh, you're not investment ready, but to say, let us help you become investment ready. You know, you can even combine the grant and the investment into the same organization. And on the things that are not investable, it's just that there are things out there that need to happen in terms of social change. They're just not amenable to market-based type of interventions. You know, if you want to move, to the theater of the oppressed instead of the theater as a physical location, that's probably something that will never really make money, and it's totally fine. But that's the kind of thing for which we need to be respectful that grants are the appropriate vehicle. And I say that just as a word of caution, because in the excitement around MRIs and PRIs, we have seen some foundations starting to want to turn everything into an investment, even where it should really have remained a grant.
Great. Well, thank you all. Those have been rich questions. I don't know if either of you would like to say a final word before we log off. Thank you for making yourselves available via contact information. I'm sure conversations will continue after this. But for now, I'd love to respect folks' time and start to close out the call. So maybe we'll back out in the same kind of in reverse of how we started. So Andrea, if you'd like to say final words, and then Alex, I'll give you the last word before I close the call.
Well, no, I just want to thank everybody for participating in this. Thanks, Biz and EPIP for inviting us. This is really at the core of our mission as a nonprofit ourselves. So if there's anything that we can do to help you on this path, by all means, please reach out, and Biz, please share information with anybody who needs it.
Will do, thank you. And Alex, thank you for helping connect us with Andrea to make this webinar possible, and for raising the question both in your work and in conversation. Do you want to say any final words before the end of the call?
Sure, just to say, of course, thanks to everyone for listening and participating and for your interest in the topic. I'm really glad it's getting airtime, and that clearly there's interest and questions about learning and moving the field, and I think that's what EPIP's trying to do best, and build, philanthropy for the next generation and to tackle the challenges of our time. So thank you all for your dedication to that work.
Thanks, and thank you, Andrea, for the resources, and to you and your team for all your work on those handouts, as well as the really rich and meaningful excuse me, slides and presentation today. I am excited to keep talking about this, and appreciate all the attendees making time. All of those that are new to EPIP, welcome again. We hope we'll see you again here. If folks can take a moment to complete the survey at the end of the call, we appreciate it, and I hope everyone has a great rest of your day. Take care.
Thank you.
Bye-bye.
Thanks.